Imagine this. It's 2035. You open your phone, and every single ad you see is from the same 5 companies. Google, Meta, Amazon, Microsoft, Apple. Not because they're the best, but because they're the only ones left who can afford to advertise. Because everyone else has been squeezed out. Now imagine this. Those 5 companies are no longer growing. Their stock prices haven't moved in a decade. The innovation has stopped. The magic is gone. And investors? They've moved on. Sounds like science fiction, right? Except it's already happening. Right now. In real time. The tech giants that once seemed unstoppable are hitting a wall. A wall they didn't see coming. A wall built not by competitors, not by regulators, not even by hackers or activists. No. This wall is built by something far more brutal. Math. Cold, hard, unavoidable math. Because no matter how much money you have, no matter how many engineers you hire, no matter how many ads you run or apps you launch, you cannot escape the basic laws of markets. And the law is simple. Everything saturates. Every market has a ceiling. Every growth story has an ending. And for the first time in decades, the tech giants are starting to realize they're running out of people to sell to. This isn't a story about competition. This isn't about TikTok stealing users from Instagram or ChatGPT disrupting Google. This is about something deeper. Something structural. Something that no amount of innovation can fix. Because the problem isn't that tech companies are bad at what they do. The problem is that they've gotten too good. They've conquered the world. And now, there's nowhere left to conquer. They've sold to everyone. Monetized everything. Optimized every click, every scroll, every second of attention. And the result? Diminishing returns. Slowing growth. Falling margins. Valuation resets. And a future that looks nothing like the past. So here's the uncomfortable truth no one in Silicon Valley wants to admit. The era of infinite growth is over. The story we've been told for 20 years, that tech always grows, that digital markets are limitless, that there's always another billion users waiting, was a myth. A beautiful, profitable, seductive myth. But myths don't last. And now, reality is setting in. The emperor has no clothes. And the tech giants? They're scrambling to figure out what comes next. This video is going to dismantle the 3 biggest growth myths that have propped up the tech industry for the last 2 decades. We're going to look at the numbers, the trends, the uncomfortable facts that Wall Street doesn't want you to see. And by the end, you'll understand why the next 10 years won't look anything like the last 10. Why the companies that once seemed invincible are now stuck. Why their stock prices are starting to crack. And why the greatest wealth creation machine in history might be running on fumes. But before we go further, let me ask you something. If you knew that the companies you invested in, the platforms you depend on, the apps you use every day were all built on a model that's about to collapse, would you change your strategy? Would you rethink your portfolio, your career, your assumptions about the future? Because that's not a hypothetical. That's the reality we're stepping into. And if you're not paying attention, you're going to get left behind. Now, if you want to stay ahead of this shift, if you want to understand where the world is really heading while everyone else is still clinging to the old story, then smash that subscribe button right now. Hit the like button. Drop a comment and tell me which tech giant you think is most vulnerable. Because this channel doesn't follow the hype. We dig into the hard truths, the structural shifts, the inconvenient realities that shape the world. And trust me, you don't want to miss what's coming next. All right, let's break this down. Let's destroy these myths one by one. And let's start with the biggest lie of all. For the last 15 years, the story has been simple. Digital advertising is the future. It's measurable. It's targetable. It's scalable. Every business on earth needs it. And the platforms that control it, Google, Meta, Amazon, are sitting on infinite gold mines. The logic was beautiful. As long as businesses exist, they need customers. As long as they need customers, they need ads. And as long as they need ads, Google and Meta will print money. Forever. But here's the problem. That story only works if demand keeps growing. And demand is not growing anymore. In fact, in many categories, it's shrinking. Let me show you why. First, let's talk about where ad dollars actually come from. The biggest advertisers in the world are not tech startups. They're not crypto exchanges or influencer brands. The biggest advertisers are legacy industries: retail, automotive, consumer packaged goods, pharmaceuticals, financial services. These industries have been the backbone of advertising for a century, and they're the ones who've been feeding the digital ad boom for the last 2 decades. But here's the catch: these industries are not growing. Many of them are stagnant. Some are in decline, and that means their ad budgets are flatlining. Take the auto industry. Car sales in the US peaked in 2016. They haven't recovered since. Electric vehicles are shaking up the market, but they're not expanding it. The number of cars sold each year is roughly flat. So why would automakers spend more on ads? They're not trying to grow the market. They're fighting over the same shrinking pool of buyers. And when you're fighting over a fixed pie, you don't increase your ad budget. You optimize it. You cut waste. You demand better ROI, which means the platforms have to deliver more for less. Or look at retail. E-commerce is growing, sure, but physical retail is dying. Department stores are closing. Malls are empty. And the shift to online doesn't mean more total spending. It just means the spending is moving. So retailers aren't increasing their ad budgets. They're reallocating them, shifting dollars from TV and print to Google and Facebook. But that shift is almost complete. There's no more budget left to shift. The well is running dry. Now, let's talk about the biggest driver of digital ad growth over the last decade: direct-to-consumer brands. The Warby Parkers, the Caspers, the Ally Birds. These companies were built on Facebook ads. They raised venture capital, spent it all on customer acquisition, and scaled fast. For a while, it worked. Facebook and Instagram delivered cheap, targeted traffic. But then the costs started rising. Apple's privacy changes in 2021 killed the targeting model. Suddenly, ads got more expensive. Conversion rates dropped, and the unit economics stopped working. One by one, these DTC brands started pulling back, cutting spend, going out of business. And the ad platforms? They lost a massive source of demand. But it's not just about who's spending. It's about how much they can spend. And here's where the math gets brutal. The price of digital ads has been rising for years. Cost per click, cost per impression, cost per acquisition, all going up. Why? Because the supply of ad inventory is limited. There are only so many feeds, so many searches, so many eyeballs. And as more advertisers compete for that inventory, prices rise. That's basic economics. But here's the kicker: advertisers can't keep paying more forever. At some point, the cost of acquiring a customer exceeds the value of that customer. And when that happens, they stop advertising. Or they cut back. Or they demand better results. Which puts pressure on the platforms. Meta has tried to solve this by showing more ads. More ads in the feed. More ads in stories. More ads in reels. But there's a limit. Show too many ads, and users leave. The platform becomes unusable. Engagement drops. And when engagement drops, ad effectiveness drops. Which means advertisers pay less. It's a vicious cycle. And Meta is stuck in it. Google has the same problem. Search ads used to be the most valuable real estate on the internet. You type in "buy running shoes," and Google shows you ads from Nike, Adidas, and a dozen others. Perfect intent. Perfect targeting. But now, the first page of Google is almost entirely ads. Organic results have been pushed down. Users are getting frustrated. And click-through rates are declining. The golden goose is starting to slow down. And then there's the elephant in the room: ad fraud. A huge chunk of digital ad spending is wasted. bots clicking ads, fake traffic, impressions that no human ever sees. The Association of National Advertisers estimated that ad fraud costs the industry over $80 billion a year. That's not a rounding error. That's a systemic problem. And as advertisers get smarter, as measurement improves, they're starting to demand accountability. They're cutting budgets, pulling back, questioning the ROI. And the platforms are scrambling to prove their value. So here's the bottom line. Digital advertising is not a limitless market. It's a mature market. Growth is slowing. Prices are rising. Efficiency is declining. And the big players are starting to cannibalize each other. Meta is competing with Google. Google is competing with Amazon. Amazon is competing with TikTok. Everyone is fighting over the same finite pool of ad dollars. And in that kind of environment, no one wins. Margins compress. Growth stalls. And investors start asking uncomfortable questions. The myth of infinite ad demand was built on the assumption that the digital economy would keep expanding forever. That every business would go online. That every transaction would be mediated by a platform. But we're already there. The transition is complete. And now, the only way to grow is to take share from someone else. That's not a growth story. That's a zero-sum game. And zero-sum games don't generate the kind of returns that made these companies trillion-dollar giants. Now let's move to the second myth. The one that sounds even more absurd when you say it out loud, but somehow Wall Street has believed it for years. This is the dream that built Facebook, Google, Amazon, and every other platform. The idea that the internet is infinite. That no matter how many users you have today, there's always another billion waiting. Waiting in India. Waiting in Africa. Waiting in Southeast Asia. Just build the infrastructure, lower the barriers, and they'll come. And once they come, you monetize them. Simple, right? Except it's not simple. It never was. Because the math doesn't work. Let me explain. Facebook has 3 billion monthly active users. That's almost 40% of the entire human population. Google has over 4 billion users across its services. YouTube has 2.5 billion. These platforms have already reached almost everyone on Earth who has internet access. So where's the growth supposed to come from? The answer Wall Street loves to give is emerging markets. But here's the uncomfortable truth. Emerging markets don't monetize. A user in the United States is worth, on average, about $60 per quarter to Facebook in ad revenue. A user in Europe is worth about $17. A user in Asia Pacific? Less than $5. A user in Africa? Less than $3. So yes, Facebook can add another 100 million users in India. But those users generate a fraction of the revenue that a US user does. And the cost of serving them, infrastructure, content moderation, localization, is often higher. So the unit economics don't work. You're adding users, but you're not adding profit. You're growing the top line, but destroying the bottom line. And it gets worse. Because those low-value users don't just contribute less revenue. They also create more problems. More misinformation. More hate speech. More regulatory scrutiny. More content moderation costs. Facebook has spent billions trying to clean up its platform in developing markets. Billions hiring moderators, building AI systems, fighting regulators. And for what? Users who generate $3 per quarter. The ROI is terrible. And investors are starting to notice. But let's say you ignore the monetization problem. Let's say you believe that eventually, these users will become valuable. That as their economies grow, their spending power will increase, and the platforms will cash in. Okay, maybe. But how long will that take? 10 years? 20? 30? And in the meantime, what happens? You're burning cash. You're diluting your margins. You're distracting your best engineers with problems that don't move the needle. And your core markets, the US, Europe, the rich parts of Asia, are saturated. Growth there is flat. So your overall growth rate is slowing. And Wall Street hates slowing growth. Now let's talk about the bigger problem. The users you already have are leaving. Not all of them. Not yet. But the cracks are showing. Facebook usage among young people in the US has been declining for years. Instagram is holding steady, but it's facing massive competition from TikTok. Snapchat has carved out a niche. YouTube Shorts is eating into short-form video. The platforms are cannibalizing each other. And the result? Users are fragmenting. They're spending less time on any single platform. And when time spent goes down, engagement goes down. And when engagement goes down, ad prices go down. The whole model starts to crack. Google has a similar problem. Search volume in developed markets is flattening. People are doing fewer searches per day than they used to. Why? Because apps have taken over. You don't search for a restaurant on Google anymore. You open Yelp or DoorDash. You don't search for a product. You go straight to Amazon. The search box used to be the gateway to the internet. Now it's just one option among many. And as Google loses searches, it loses ad inventory. And as it loses ad inventory, it loses revenue. The dominance is slipping. And then there's the demographic problem. The internet is aging. The early adopters, millennials, Gen X, are getting older. They're spending less time online. They're scrolling less, clicking less, buying less. And the younger generation, Gen Z and Gen Alpha, they're not using the internet the same way. They're on TikTok. They're on Discord. They're in games. They're in private group chats. They're not Googling. They're not posting on Facebook. They're not even reading email. The behavior has shifted. And the platforms that dominated the last era are struggling to adapt. Meta has tried to pivot. They've bet the company on the metaverse. They've rebranded. They've spent tens of billions on VR and AR. But no one cares. The metaverse is a ghost town. The VR headsets are sitting in closets. And meanwhile, their core business, ads on Facebook and Instagram, is slowing down. The growth engine is sputtering. And investors are getting nervous. So here's the reality. The era of user growth is over. The platforms have reached everyone they're going to reach. The next billion users won't move the needle. The users they have are fragmenting, aging, and spending less time engaged. And the competition for attention is fiercer than ever. This isn't a temporary blip. This is a structural shift. And it means that the growth rates that powered these companies to trillion-dollar valuations are gone. Forever. The assumption was always that tech platforms would grow like TV networks in the 1950s. That they'd become universal utilities. That everyone would use them, all the time, forever. But that's not how technology works. Technology is cyclical. Platforms rise. They peak. They decline. And new platforms take their place. We saw it with MySpace. We saw it with Yahoo. We saw it with AOL. And now, we're starting to see it with Facebook, Twitter, and maybe even Google. The dominance was never permanent. It just felt that way because the growth lasted so long. But growth always ends. And when it does, the valuation multiples collapse. Because a company that's not growing is just a cash cow. And cash cows don't trade at 30 times earnings. They trade at 10 times. Maybe less. And that means trillions of dollars in market cap could evaporate. Not because the companies are failing, but because the story changed. And in the stock market, the story is everything. Alright, let's move to the third myth. This one is a bit more subtle. It's not about ads. It's not about users. It's about the enterprise. The idea that businesses will spend more and more on cloud computing, software, and IT services every single year. Forever. That Amazon Web Services, Microsoft Azure, and Google Cloud will just keep growing at 30%, 40%, 50% a year because every company on earth is going digital and digital requires cloud. For a while, this story made perfect sense. 10 years ago, most companies were still running their own servers. They had data centers. They had IT departments managing hardware. It was expensive, inefficient, and slow. Then AWS came along and said, "Why manage your own servers? Rent ours. Pay for what you use. Scale up and down instantly." It was revolutionary, and companies bought in. Startups went cloud-native from day one. Enterprises started migrating, and the cloud providers started printing money. But here's the problem: that migration is almost done. Most companies that were going to move to the cloud have already moved. The low-hanging fruit is gone, and now growth is slowing. Why? Because cloud spending is not infinite. It's tied to business activity, and business activity is not growing at 40% a year. In fact, in many sectors, it's barely growing at all. Let's talk about what drives cloud spending. It's not magic. It's workloads. When a company launches a new app, starts analyzing more data, or scales up its operations, it uses more cloud resources. But when growth slows, when the app is mature, when the data pipeline is optimized, cloud usage flattens. And that's what's happening now. The explosive growth phase is over. Companies have moved their workloads to the cloud. They've optimized them. And now, usage is stabilizing. But it's worse than that. Because companies are getting smarter. They're realizing that the cloud is expensive. Really expensive. A few years ago, Dropbox famously moved most of its infrastructure off AWS and back to its own data centers. Why? Because they were spending $75 million a year on AWS, and they realized they could build their own infrastructure for a fraction of that cost. They're not alone. Lots of companies are doing the same thing. They're moving workloads back on-premise. They're negotiating harder with cloud providers. They're shopping around. They're multi-clouding to avoid lock-in. And they're cutting costs. And then there's the macroeconomic picture. When interest rates were zero, companies had cheap capital. They could afford to spend big on IT. They could invest in transformation projects, new software, new infrastructure. But now, interest rates are up. Capital is expensive. Budgets are tight. CFOs are cutting costs. And IT spending is one of the first things to get slashed. We're already seeing it. Microsoft's Azure growth rate has been decelerating for quarters. AWS growth is slowing. Google Cloud is still growing fast, but it's burning cash to do it. The margins are thin. The competition is brutal. And the easy money is gone. Now, let's talk about another uncomfortable truth. Most companies don't need more cloud. They've already digitized. They've already moved their email to Google Workspace or Microsoft 365. They've already migrated their databases, their apps, their analytics. What's left? Incremental growth. Small optimizations. Marginal improvements. That's not the kind of growth that justifies the valuations these companies have. And then there's the existential threat, repatriation. As cloud costs spiral, as lock-in becomes a problem, more and more companies are going to bring workloads back in-house. They're going to build hybrid systems. They're going to use edge computing. They're going to find ways to reduce their dependence on AWS, Azure, and Google Cloud. And when that happens, the growth story collapses. But wait, there's more. Let's talk about the elephant in the room, AI. The narrative right now is that AI is going to supercharge cloud growth. That every company is going to need massive compute power to train models, run inference, and build AI-powered products. And that's going to drive a new wave of cloud spending. Microsoft is betting the company on it. Google is racing to catch up. AWS is investing billions. But here's the problem. AI compute is different. It's not like running a web app or storing data. It's insanely expensive. Training a large language model can cost tens of millions of dollars. And most companies can't afford that. They're not going to train their own models. They're going to use pre-trained models from OpenAI, Google, or Microsoft. Which means the spending is concentrated. A few big players spend big. Everyone else spends very little. And that doesn't create the kind of broad-based growth the cloud providers need. Plus, AI is still speculative. Yes, everyone is talking about it. Yes, there's a lot of hype. But how many companies are actually generating ROI from AI? How many have deployed AI systems that are driving real revenue or real cost savings? The answer is, not many. Most companies are still experimenting. Proof of concepting, piloting, and pilots don't generate massive cloud bills. Production workloads do. And we're not there yet. We might not get there for years. And in the meantime, the cloud providers are betting billions on a future that may not materialize. So here's the reality. Enterprise IT spending is not infinite. Cloud growth is slowing. Companies are optimizing, cutting costs, and bringing workloads back in-house. The migration wave is over. And the next wave, AI, is speculative, expensive, and concentrated. This is not the growth story that Wall Street priced in. And when the market realizes that, valuations are going to reset hard. Now, let's zoom out. Let's connect the dots. Because the three myths we just destroyed are not isolated problems. They're symptoms of a deeper issue. And that issue is this. The tech giants have built their entire business model on growth. Infinite, compounding, exponential growth. And that model is breaking. Here's how it worked. For the last 2 decades, the tech giants were able to do something that no other industry could do. Grow revenue and profit at the same time. They weren't like car companies, which had to build factories and hire workers to grow. They weren't like retailers, which had to open stores and manage inventory. No, the tech giants had magic. Software. Software scales infinitely. Once you build it, you can sell it to 1 million people or 1 billion people at almost zero marginal cost. That was the promise. That was the dream. And for a long time, it was real. But now, the dream is fading. Because even software companies hit limits. They hit market saturation. They hit competition. They hit regulatory walls. And when they hit those limits, the growth stops. And when the growth stops, the magic disappears. Suddenly, they're just normal companies. Companies with costs, with competition, with challenges. And normal companies don't trade at 40 times earnings. They trade at 15 times. Maybe 10 times if things are bad. And that means trillions of dollars in market value are at risk. Let's talk about the valuation problem. Apple is worth $3 trillion. Microsoft is worth $3 trillion. Google is worth $1.8 trillion. Meta is worth $900 billion. Amazon is worth $1.5 trillion. These valuations were justified by one thing: growth. The assumption that these companies would keep growing revenue at 15%, 20%, 25% a year for the foreseeable future. But what happens when growth slows to 5%, or 3%, or 0? What happens when the market realizes that these companies are mature, saturated, and stuck? The answer is simple. The valuations collapse. Not overnight. Not in a crash. But slowly, steadily, painfully. The multiples compress. The stock prices stagnate. And investors move on to the next thing. We've seen this before. IBM was once the most valuable company in the world. So was GE. So was Exxon. They didn't disappear. They didn't fail. They just stopped growing. And when they stopped growing, the market stopped caring. The same thing is going to happen to the tech giants. It's already starting. Look at Meta. The stock crashed in 2022. It's recovered since, but the growth trajectory is broken. Facebook usage is flat. Instagram is under pressure. WhatsApp is free. And the metaverse is a money pit. Where's the growth going to come from? Wall Street doesn't know. And neither does Mark Zuckerberg. Look at Google. Search is still dominant, but it's slowing. YouTube is massive, but it's competitive. Cloud is growing, but it's not profitable. And the company is burning billions on moonshots that go nowhere. Waymo. Verily. Google Fiber. Wing. Projects that sounded great in pitch decks but haven't moved the needle. Look at Amazon. E-commerce growth in the US is decelerating. AWS is slowing. Retail margins are thin. And the company is fighting regulators, unions, and competition on every front. The empire is creaking. And then there's Apple, the most valuable company in the world. But iPhone sales are flat. Mac sales are flat. iPad sales are flat. The growth is coming from services, subscriptions, App Store fees, iCloud storage. But services growth is slowing too. And there's only so many times you can raise prices before customers revolt. Apple is a great company. But it's not a growth company anymore. It's a cash machine. And cash machines don't deserve $3 trillion valuations. Now, let's talk about what happens next. Because this isn't just about stock prices. This is about the entire structure of the tech industry. For the last decade, the giants have dominated. They've acquired competitors. They've crushed startups. They've locked up talent. They've set the rules. But now, the power is shifting. And it's shifting for a simple reason. They're running out of money. Wait, what? Running out of money. These are the richest companies in history. How can they run out of money? They're not running out in the sense of going bankrupt, but they're running out of free cash flow. They're running out of cheap capital. They're running out of the financial flexibility to do whatever they want. Let me explain. For years, these companies generated massive profits and threw them at everything. They bought companies for tens of billions. They built data centers by the dozens. They hired engineers by the thousands. They paid out huge stock-based compensation packages. And it worked because the stock price kept going up. But now, the stock prices are under pressure. And that changes everything. When your stock is flat, stock-based compensation is less attractive. So you have to pay more cash to retain talent. But cash is expensive. And when you're paying more in cash, your margins shrink. And when your margins shrink, investors get nervous. And when investors get nervous, your stock falls. And when your stock falls, you have to pay even more to retain talent. It's a vicious cycle. And it's already starting. Meta laid off 20,000 people in 2023. Google laid off 12,000. Amazon laid off 27,000. Microsoft laid off 10,000. These are not signs of strength. These are signs of a business model under pressure. The infinite growth party is over. The hangover is here. And it's going to be brutal. And then there's the regulatory pressure. For years, the tech giants operated in a legal gray zone. They acquired competitors without scrutiny. They collected data without oversight. They set their own rules. But now, regulators are waking up. The EU is cracking down. The US is filing antitrust cases. China is reining in its tech giants. India is demanding local control. The free-for-all era is done. And the costs of compliance, of legal battles, of breakups, they're going to add up. They're going to eat into margins. They're going to slow growth. And they're going to make it harder to do business. So here's what the next decade looks like: slower growth, higher costs, tighter margins, and lower valuations. The tech giants will still be big. They'll still be profitable. But they won't be the unstoppable wealth machines they were. They'll be normal companies, facing normal challenges, generating normal returns. And for investors who priced in infinite growth, that's going to be a painful adjustment. But it's not just investors who will suffer. It's employees. It's startups. It's the entire ecosystem. Because when the giants stop growing, they stop hiring. They stop acquiring. They stop funding new projects. And that means fewer opportunities. Fewer exits. Fewer success stories. The golden age of tech is ending. And what comes next is going to be harder, leaner, and less glamorous. Now you might be thinking, but what about AI? Isn't AI going to save them? Isn't AI the next big thing? Maybe. Maybe not. AI is powerful. It's transformative. But it's also expensive, unpredictable, and speculative. We don't know yet if AI will generate the kind of returns that justified the last wave of growth. We don't know if it will create new markets or just automate existing ones. We don't know if it will be concentrated in a few giants or distributed across many players. There are a lot of unknowns. And betting trillions of dollars on unknowns is risky. Plus, even if AI does deliver, it might not help the current giants. It might help new companies. Startups built from the ground up around AI. Companies that aren't weighed down by legacy infrastructure, legacy business models, legacy cultures. History is full of examples where the incumbents missed the next wave. IBM missed PCs. Microsoft missed mobile. Google missed social. It happens. And it could happen again. So here's the bottom line. The tech giants are not invincible. They're not immune to the laws of markets, of competition, of saturation. They've had an incredible run. But the run is ending. The myths are crumbling. And the future is uncertain. The companies that once seemed like they would rule the world forever are now facing the same challenges that every dominant company eventually faces. Slowing growth, rising costs, fierce competition, and a market that's moved on. This is not the end of tech. But it is the end of an era. And if you're invested in this story, if you're building your career on this story, if you're betting your future on this story, you need to wake up. Because the world is changing. And the sooner you adapt, the better. So where does this leave us? Standing at the edge of a cliff, looking down at a very different landscape than the one we've known. The tech giants built empires on 3 pillars: advertising demand, user growth, and enterprise spending. And all 3 pillars are cracking. Not because the companies are poorly run. Not because they lack talent or vision. But because they've run out of room to grow. They've saturated their markets. They've captured their customers. They've optimized their operations. And now, there's nowhere left to go. The next 10 years will not be about growth. They'll be about defense. About protecting margins. About fighting off competitors. About navigating regulatory minefields. About trying to find the next big thing before it's too late. Some of these companies will succeed. They'll adapt. They'll pivot. They'll find new revenue streams. But some won't. Some will stagnate. Some will decline. And some will become the cautionary tales that the next generation of entrepreneurs studies. And here's the thing. This isn't a bad thing. This is just the natural cycle of business. Companies rise. They dominate. They decline. And new companies take their place. That's how progress happens. That's how innovation happens. The fall of the old guard creates space for the new guard. And right now, somewhere in a garage or a dorm room or a co-working space, the next generation of giants is being born. Companies that will look at the mistakes of Facebook, Google, and Amazon and do things differently. Companies that will build for a world that's more regulated, more fragmented, more skeptical. Companies that won't rely on infinite growth, but on sustainable business models, real value creation, and actual innovation. So if you're watching this, if you're paying attention, if you're thinking about where to place your bets, bet on that future, not on the past. Because the past was beautiful, but it's over. And the future? The future is going to be messy, chaotic, and unpredictable. But it's also going to be fascinating. And if you're smart, if you're nimble, if you're willing to challenge the conventional wisdom, you can win in that world. The tech giants are running out of buyers. They're running out of growth. They're running out of time. But the story doesn't end with them. It's just beginning. And the question is, are you ready for what comes next? Are you going to cling to the old myths? Or are you going to see the world as it really is? Because that choice, that's what will determine whether you thrive or survive in the decade ahead. If this video opened your eyes, if it made you question the narratives you've been fed, if it gave you a new lens to see the world through, then do me a favor. Hit that subscribe button. Share this video with someone who needs to hear it. Drop a comment and tell me which of these 3 myths surprised you the most. And stick around, because we're just getting started. There's so much more to uncover, so many more truths to expose, so many more myths to destroy. And I'll be here every step of the way, cutting through the noise and giving you the real story. Thanks for watching. Stay sharp, stay skeptical, and I'll see you in the next one.